So today, on today's episode of I Must Ask You a Question, I brought in a good friend of mine, Theron Smith, with Lender's Choice Credit Solutions. How are you today, bud?
Doing good, man. How about you?
I'm doing good. I'm doing good. Thank you. I'm finally back in the office. A
Really
few
good to
days out
hear.
of the week now that the kids' school is practically over. Official last day, I think, is tomorrow. And so, yeah, I'm now able to kind of get away from the house, come back into the office, and whatnot. So, thank you for joining us today, everybody. Today, we're going to talk to you. Well, Theron's going to talk to you because he's the specialist. He's going to share with some tips on credit, on how you can improve it, what not to do, what to do, and go from there. So, if you have any questions in regards to credit, feel free to post them. I'll try to catch them on Facebook and whatnot, and we'll just kind of dive in. So, Theron, talk to us a little bit about how to improve your credit.
Yeah, so obviously, credit scores can be very important, especially if you're looking to make any big purchases and you're not just loaded with cash, right? Now, if you're one of these people that just have millions of dollars in cash, then maybe you're not worried about your credit too much. But for the rest of us normal people, leveraging your credit is a big deal. Being in a place where when you want to buy a home, a car, whatever, that you are in a place where you get the best rate on things. Basically, credit, typically for when we'll talk about homes in general, and when someone's going to purchase a home, typically the reasons why they are scared to or don't buy a home is because either their credit is bad or they don't think they have enough money. And I would argue, and Dane says this all the time, that the reason they don't have enough money is probably because their credit is bad. And the reason for that is when your credit isn't in a good place, you're paying more for everything. All your interest rates are higher. You're paying deposits on utilities that other people aren't paying. So you're basically putting yourself at a disadvantage. So having good credit really leads to you typically having more money because you're able to leverage those things. So it's important to understand that they kind of coincide with each other at times. I'm not saying you're going to be rolling in cash just because you got a 700 credit score, but the odds are more likely.
Yeah.
You still got to learn how to save.
Yeah, and really, when it comes to buying a house too, I come across clients who they're like, "Hey, I got plenty of money to put down, but my credit's shot." I'm like, "Okay, cool. So you're paying cash for the house?" They're like, "Well, no, I don't have that type of money. I mean, I got maybe 10-20% to put down, but I still need financing." I'm like, "Well, let's get you with the lender, because if your credit's shot, they're going to be the ones they be able to tell you, and then if they can't help, then we send them." To someone like you with, Lender's Choice Credit Solutions to help get their credit better, because they think, oh, credit doesn't matter because I have money. Well, like you said, they coincide with each other, especially when you're trying to finance either a big purchase, a house, a car, things like that. So yeah, definitely, I agree. So share a few tips on what, someone can do to help improve their credit.
Yeah, so one of the biggest things that you want to make sure, besides paying your stuff on time, obviously, getting late payments is hurtful. When you think about the scoring models and how they all work, one of the biggest things you can do is keeping your credit card utilization down. Credit card utilization doesn't mean don't use the credit cards. It doesn't mean don't gain those reward points and all those type of things. But it means understanding how they report to the bureaus and understanding when to pay them, how much to pay down, all those type of things. We typically tell our clients to pay down below 10% utilization. So whatever your overall credit limits are on your cards, you want to keep that utilization down to around 10%. That's kind of the prime spot to be. Obviously, I'm sure you've heard 30%, which is great. If you can get below 30%, that's great. But really, the most benefit you're going to get is when you get 10% and below. If you have a great credit score already, you're in the 800s already, all that stuff. If you pay the balance to zero every month, it's not going to be as big of a deal for you. But if you're someone who's trying to build your credit, you want to leave a balance on there because that's how you show that on-time payment history. You show that you're utilizing it, but you're not overutilizing. So that's one of the biggest ways that you can do that.
Yeah, definitely. I've come across people in the past who, they're trying to build up the credit, and someone who wasn't a specialist in credit or didn't really know what they were talking about, they said, okay, yes, get a credit card. Cool, I got it. Go ahead and spend it. I've had people where they would say they got maybe $1,000 approved for a credit card, or even $250, $500, whatever the amount is. And they're like, I'd max it out, but then I'd pay it off, right away. And I'm like, well, that's not probably going to help. That may actually hurt you. I mean, I don't know.
It doesn't give you the most benefit. So obviously getting that new credit card, it's going to add limit to what you have. So it's going to lower your overall utilization. So there's going to be some benefit. But if you're trying to get the max benefit, you're trying to build your score fast, leaving a little bit of balance is actually the key to doing that. But it's also understanding how they're reporting to the bureaus. So a lot of people, we've seen people that have 800 credit score one month and 670 the next month. And the reason is because they're maxing out the credit card and they're paying it off. But when they're paying it off, it's already reported. And so now they've got a great credit score. So they have a $5,000 limit, and they spent $4,500, and they paid it on the due date. But most of those credit card companies are reporting 4, 5, 6 days before the due date. And so they paid it on the due date, and now their balance is showing $4,500 out of the $5,000 on their credit report, and they're showing that they're at 95% utilization. So now it's making them look irresponsible, right? Like, oh man, you're just maxing out cards. It's the shock to the scoring model, because now they've maxed out that card. So you have to understand how they're reporting as well, because if you wait too long to make that payment, then you're putting yourself at a disadvantage still.
Gotcha. Yeah, obviously I wasn't smart in when I first got out of high school. You know what I mean? And when you first get out of high school, this is where a lot of people really do damage to their credit, just like I did in the past, and it was, I got approved for my first credit card. Boom, let's go party it up. And then you get behind, and then life happens and whatnot. And I've been there. I've had credit scored down to almost probably even under 500, if that's possible. I mean, I was in bad shape in the past, and I was able to rebuild it slowly but surely. Did some great things. I know some tips that like you're going to share. I've done that in the past to help jump it up and get to where I am today, which is I'm in a great spot today. I would say that.
Yeah.
So other than utilization, what are maybe some other things that you can share with us today?
Yeah, so utilization is obviously key. There's also been some unique things that we found over time on people's credit reports that you don't think of looking at. So we've had times where people have been off. Their score's been off just by a little bit. They're trying to figure out, how do I get this score up? And we take a look at their credit report, and we see that their credit cards, an installment loan or something, is only reporting to one bureau or two bureaus. A lot of people just assume that things are always reporting to all three bureaus. And that's why the other bureaus are a little bit lower. As you know, when you're getting a home, the lender is going to take the middle score, right? So all three scores matter because.
I think you're freezing. You're freezing up there a little bit.
So am I back?
Kind of, yeah. I can hear you now. Yep. It's in and out.
Sorry. So it's important. Can you hear me?
Yeah, I can.
It's coming through smooth on my end.
Okay. For some reason on my end, it's not. Maybe just keep going, and maybe for everybody else, maybe it's me.
I was just saying, so you want to make sure that when you look at your report that things are reporting the way they're supposed to. So make sure that they're reporting to all three bureaus. That could be an easy fix that you didn't even know was an issue. And so that's something to look at. And so that's just some unique things that we found over time. Actually, I just found one. I just talked to a lady earlier today who was needing some help on her scores. And I realized that her Wells Fargo credit card was only reporting to one bureau, and it was reporting a balance even though she paid it off in February.
Oh, wow.
So it was reporting as if it was, like 75% utilization, and it was paid off to a zero balance in February. So I told her, I was like, well, instead of paying us to remove one of these medical collectors or something, start with that. Call Wells Fargo and tell them, hey, 1, you're not reporting to all bureaus. 2, you're not reporting correctly, and have them. So that's kind of.
Gotcha.
Sometimes there's other ways to do those things.
Okay. Now, tell me a little bit. I mean, how can someone know about that? You know, where does it start for a consumer to figure that part out?
Yeah. So we use a credit monitoring company called Identity Club. And we use them because we found them to be the most accurate. If anybody wanted to utilize that, they'll give all 3 reports. When you're in our program, you're required to have this because we need to review a new report every 30 days while you're in the program. We got to go through it and make sure that the work is being done, things are being removed like they're saying they're being removed. But a company like that we use is very, very accurate, the way that they report and the way that they handle those things. And so I'd recommend having something like that in place. If you want a link to Identity Club, I can always give you that. If anyone's interested, I can put that in the comments later if you need it, so that you can review it. But when you go through and look, you can see on the report, it'll show you the initials for each bureau. If it only shows one initial, then if it only shows TU, then it's only on TransUnion. So you want to make sure when you're going through there, like, oh, well, look at that. This has only been reporting one bureau for the last 5 years. I missed out on 5 years of payment history because they didn't report it correctly. And so you have to then get them to do so.
Cool. Got it. So basically, I'll just sign up with you and you can monitor it for me. How about that?
I charge a lot if I'm just monitoring a credit score. Okay.
Yeah.
But yeah. So another thing I wanted to talk about because it's very important during this time, but is student loans. So the reason I wanted to bring it up, I'll explain here in a second. But the reason I want to bring it up is because student loans are a unique thing. When you have a federally backed student loan and it goes into default, it's not the end of the road for you. So for some people watching, this may be a shock to you because once something goes into collections, that typically means it's over, right? It's in collection, it's being collected on. There's no way to ever get it out of there. Yeah. But with federally backed student loans, you can actually get into a loan rehabilitation and get that pulled out of default. And right now is a really great time for it because of the COVID or Corona or whatever you want to call it. Because of all that stuff going on, they're not actually taking payments. But they will set you up on the loan rehabilitation program, and you won't have your first payment until October, as of right now. If things change, it could get pushed out further, but you won't have your first payment until October. So if your student loans are in default, you definitely want to work on those now because you're getting 5 months of payment history towards the 9-month rehabilitation without actually making a single payment.
Oh, wow. Now that's an awesome tip right there. So for all of you who do have that student loan debt,
yeah. If you've been pushing off that student loan, if you've been pushing off that defaulted student loan, now is the time to make it happen.
Yeah. No, that's awesome. So what about, let's say, medical bills? How important are medical bills? When people, obviously, life events happen, they get behind on them. And then you have the doctor offices, the hospital office, all these people who build you coming after you, trying to get you for a certain minimum payment or at least setting up something, but then they say, oh, I'm going to report you. And I mean, how does that affect your credit?
Yeah. So one myth out there is that you've heard from people before is, oh, medical payments won't affect your credit score. That's not true. So if a collection is a collection is a collection. So don't let people lie to you about that. I don't know where that started. I'm sure there's scoring models where it doesn't have the same effect. Because you have hundreds of credit scores. You don't have one, you don't have 5, you have hundreds of versions. So, credit scores are very unique because there's so many different versions. A lender's going to pull one version, an auto loan's going to pull one version, insurance is going to pull one version, credit cards are going to. So there's just so many different versions of it. But medical collections do affect the credit scores. So I just want to make that clear so no one has confusion anymore. So those do affect it. Now, there are some things with mortgage lenders, and I think this is where maybe the miscommunication comes in, because if you don't know, a mortgage lender is required to take 5% of your collection debt and put it towards your debt to income. But medical debts don't affect that. And so that's why sometimes people think, oh, the medical debt's not affecting me. Well, it's not affecting you as far as your debt to income, but it is affecting you as far as your score is concerned. So the way you would handle medical debts, or collections in general. So if you have collection companies calling you, I would say as a very, 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 very last resort, do you pay those collections? Because when you pay a collection, it doesn't improve your credit score. A collection that's a zero balance is just as negative as a collection that's a $10,000 balance. So sometimes you can get them to agree to give you a letter of deletion and actually remove the item if you pay it off. But that's very rare, and I wouldn't count on that, because even I talked to a guy earlier today actually, and he was like, yeah, they said they sent me a letter of deletion, but it's been 3 months now, and I've been bothering them and bothering them and bothering them. Collection companies are going to say whatever they can to get you to give them money. Okay, they're not there to help you. They're not your friend, no matter how nice they sound or what they do. They're there to collect your money. Those call center reps are getting paid for collecting your money. That's what their job is. And if you want to pay off your debts, awesome. I'm just letting you know that it's not going to improve your actual credit score. Never tell people not to pay off their debt. Just tell them if you're looking to improve your credit score, then that's not the way to go.
Got it. So
yeah. I would recommend, if you have a lot of those collections, I would recommend talking to someone like us who can help you with deletions of those things without paying them.
Yeah. So you don't only just do credit deletions, you can also educate and help someone in your program to better their score, regardless on getting things deleted by, doing other sorts of things. One thing I wanted to ask you was, I've heard certain people talk about it, and it's okay. So I have bad credit, for example. Let's just say this, for example, if I have bad credit, but my spouse or partner has wonderful credit, what about jumping on some of their credit lines or credit cards or something? Does that work? Does that help?
Yeah.
Does it hurt?
So adding an authorized user to the credit card is kind of what you're talking about there. And if you are married, if you have the same last name, if you are family, really we try to stay within spousal relationships. Ethically, that is the correct way to do it. Now, obviously, if a parent wants to help out their 20-year-old kid and put them as an authorized user, if you guys have the same last names and all of that, then it is going to affect you positively if it's a positive file. So you got to make sure that it's not maxed out, it doesn't have late payments, all of those type of things. But yes, so that can help you, and we tell people about that all the time. Like I said, ethically, and because sometimes it won't work if you just jump on a random person's authorized user. Sometimes it won't reflect because the names don't match and all that. So there's a lot of factors there. Also, it's not very ethical to do that. There's also companies out there that will sell you on paying them to be on lines of credits or trade lines and adding those to your account, positive trade lines, and that's fraud. Even though they're selling that to you, doing that, just so you know. Being added to some random person's line of credit is not the right thing to do.
Wow. Yeah. Because I've heard about somebody doing that before, where they sign up for a company and you're basically you're making money because these other people are paying you to add them for 2-3 months or whatever to help their credit score. So that's actually fraud, is what you said. Yeah.
Because you don't have any. There's no connection there. There's no. You're not family. You're not using that line of credit, none of those type of things. You're not paying that, like there's no connection there. And so technically that's bank fraud. But people get away with a lot of things these days. Obviously no one's complaining when it's helping their credit score, only when it's negative, right?
Yeah, exactly. Cool. So I don't want to take up too much of your time, but we'll wrap this up. And I have probably one of the most infamous questions that I get when I talk to clients, and it's, my score on Credit Karma is this. I should be able to qualify for a home, right?
Yeah, good old Credit Karma. So, I mean, in general, what we tell people, if you want to know what your credit score is for a mortgage, then talk to a mortgage lender. Because that's the only way you're going to find exactly what that score is for the lender. The reason is, I mentioned earlier, you have hundreds of scores, And the scores that most credit monitoring companies like Credit Karma and all of them are using is something that the bureaus have created themselves called a Vantage 3.0 score. And it has a completely different model. For instance, paid collections on the Vantage 3.0, if you pay a collection, your score will go up. And so then it tricks people. And they think, oh, if I pay my collections, my score is going up. And then they go to a lender and it's just as bad as it was before. And so that Vantage 3.0 is something that was created by the bureaus to try to, it's a money grab. They want the lenders to be using those, but the lenders are still using FICO. It's basically a fight between the bureaus and FICO on trying to see which scoring model, which one people adopt. And lenders have pretty much stuck with FICO and the classic score for the longest, and I don't see them changing that anytime soon. I feel like it gives them the best risk assessment as far as that's concerned. So the Vantage 3.0 can sometimes be a placebo score. You know, it makes you feel good. It's a sugar pill. You did some things and you're like, ooh, look, my score is great. And then you realize, wait, not as good as I thought. So that's why when we sign up people, even for Identity Club, when we sign people up for it, we say, you know, you can look at the score. It is a Vantage 3.0 score. But really what we're doing it for is the report itself. We want to have alerts when something happens, when we want to see what's actually being reported. That's what we're looking for. And that's why we use that company specifically, because the accuracy on that is way better than a Credit Karma or something like that. But the score is what it is. If you want an actual score for an auto loan, talk to a lender who does auto loans. If you want a score for a mortgage, talk to a mortgage lender, because that's the only way you're going to get it.
Got you. So someone asked, is adding your kids to your credit card okay?
Yes, if they're of legal age. You know, I've heard of people, you know, putting like their 15-year-old or 16-year-old as an authorized user. I don't know that that's legal, but you can get away with that stuff. But yeah, you can add your kids to it. That's family. There's a connection there. You're not getting financial gain for adding them to it, right? Like you're not charging them $200 a month to have this credit line to help build their credit. That's where the fraud comes in.
Got you. Awesome. Well, Theron, thank you so much for sharing all this. I'm sure a lot of people got some amazing information. How can they connect with you? How can they learn more about what, you know, you and Lenders Choice Credit Solutions does? Can you just share a little bit about that and your contact information, and that way people can get a hold of you?
Yeah. So phone number 469-225-0832. Email is my first name, Theron, which you can see across the bottom there, at Lenders CCS. So Lenders Choice Credit Solutions, CCS.com. And I'll go comment on this afterwards with my contact info as well. But what we do is it's pretty straightforward. We're going to go through the reports. We're going to walk through them with the client, figure out what's going on, figure out why their scores are where they are. Do we have collections, charge-offs, late payments? And those are the things we're going to target first to try to get removed. We try to get as many of them removed as possible in a legal fashion. So we do that by leveraging the Fair Credit Reporting Act, trying to find any type of inaccuracies. If anything on your report is not 100% accurate, then it is a violation of the Fair Credit Reporting Act. So that's what we leverage to the bureaus, the collection companies, the original creditors, and we try to hit all three of them, which makes these removals more permanent. So if they can't come back with the valid documentation to completely 100% prove the validity and accuracy of those accounts, they have to be deleted or they'll be fined for violating the Fair Credit Reporting Act. So that's kind of the process there, is going through. That's how we get the deletions. Now, obviously, if they come back and they validate everything, then you know that's one of those times where that item can't be removed, and legally you can't go any further than that. But our job is to go through and try to find any type of inaccuracy that we can, really kind of nitpick and bite through it, because especially with collection companies, those are the ones that don't have accurate stuff. They don't have the original documentation. They bought these debts for cheap, and so they're not able to provide that documentation most of the time when the bureaus come to them. So collections, medical collections are the easiest of all of those. So stop paying those $70 medical collections when we can get them removed. So those are the easiest ones. And then you get into the charge-offs, which are with the original creditors, which can be a little bit trickier because they're probably going to have original documentation, but there's other ways to try to fight that and combat that we work on. So they're still removable. It's just a matter of doing the work and finding the ways to get it off. And then late pays as well, kind of a similar situation where we'll go through and try to get those items removed. And it's a little bit trickier because were you late or were you not? So we got to hope that they report something inaccurately, right? Like they could report April 2nd as the late day instead of April 14th. You know, there's ways where even that is a violation. And so that's kind of the process that we take. We also walk through with the good stuff for people. So what credit cards do you have? What's your utilization rates? Do you not have any credit cards? We have secured credit card companies that we work with that have guaranteed approvals to help build that history, because revolving credit is way more impactful to your credit score than installment loans. So that's very important to have, because you're putting yourself at a disadvantage if you don't have something in revolving credit. So that's kind of what we do. Average clients with us about 3 to 4 months, max is 6 months. So we try to get a quick turnaround. We try to be in and out. We're not like the Lexington Law, creditrepair.com. We try to keep you in the program for 3 years and charge you monthly fees for 3 years and try to collect as much money as possible. We even have a pay-per deletion plan. So we have a plan where you literally only pay for what gets done.
Awesome. Well, thank you so much for sharing all this. Everybody, you know, if you're working on your credit and you're trying to do it on your own, kudos to you. But if you're struggling and you need some help or you're not seeing the results, definitely reach out to Theron, Lender's Choice Credit Solutions, and let him come up with a game plan for you to put you in the best position of why you need your credit score higher. So thank you so much, Theron. I appreciate it. Thank you all for tuning in, and we will see you next time.
Thanks.